This is a demonstration of problem 12AB-38A, determining the present value of bonds payable and journalizing using the effective interest amortization method. Relaxation Inc. is authorized to issue 7% 10-year bonds payable. On January 1st, 2024, when the market interest rate is 12%, the company issues $300,000 of the bonds. The bonds pay interest semi-annually. In the requirements, it asks us first to determine how much cash the company received upon issuance of the bonds payable. So Relaxation Inc. is issuing bonds that pay interest at 7%. However, at the time that the bonds are issued, the market rate is 12%. So that means that the company is not going to receive the full face value of $300,000 for the bonds. They will be issued at a discount so that the bondholders will effectively earn 12% on these bonds. So the first thing you need to do is to calculate the present value of the $300,000 face value of the bonds using the market rate of 12%. So how do we do that? Well, you use a present value factor. So to make the calculation of the present value easier, there are tables that you can use. So in your textbook, there is a table called Appendix A1, or the present value of one table. We use that table to determine the factor that we can use to discount the $300,000 back to today at the market rate of interest. But to determine the interest rate, we first look at our problem and we see that the market rate is 12%, but the bonds pay interest semi-annually. So you always take your market rate of interest and divide it by 2, and that will give you your interest factor. Next, we look for the term of the bonds, and we see that these are 10-year bonds. However, again, these bonds pay interest semi-annually. So the bondholders are actually going to receive 20 interest payments, 2 per year for 10 years. When you go to the table and you look for the intersection of the interest rate of 6% and the number of periods 20, you will find the present value factor of 0.312. When we multiply that by the face amount of the bonds, $300,000, we get the present value of the bonds at the market rate of 12%, which is $93,600. Next, we need to determine the present value of the semi-annual interest payments. First, we need to determine what the amount of the semi-annual interest payments will be. So we take the face amount of the bonds, which is $300,000. We multiply it by the stated rate, or the coupon rate on the bonds, of 7%. Then we multiply that by 0.5 because these will pay interest twice a year. And we see that the semi-annual interest payments for the bonds will be $10,500. So now we need to determine what the present value of the 20 semi-annual interest payments of $10,500 would be at the market rate of 12%. We use a different table for this because these are a series of payments, or what we call an annuity. And so for this, we will use the Appendix A2 table, which is the present value of an ordinary annuity. The ordinary part just means that the payment comes at the end of the period. So the first interest payment date would be, if the bonds are sold on January 1st, would be on June 30th at the end of 6 months. So when we go to this table and we find where I equals 6 and N equals 20, where that row and that column intersect, we find the present value factor of 11.470. When we multiply that by the $10,500 semi-annual interest payment, we get the present value of those payments at the market rate of 12% of $120,435. So to determine the present value of the bonds, we take the present value of the principal and the present value of the semi-annual interest payments, and we add those together, and Relaxation Inc. would actually receive $214,035 when they issue these bonds. Now, in the second part of the problem, it asks us to prepare an amortization table for the bonds using the effective interest method through the first two interest payments and round to the nearest dollar. So when the bonds are sold, the carrying amount of the bonds is $214,035, the amount that we received when they were issued. We've already calculated our semi-annual interest payments to be $10,500. That is the amount of cash that the bondholders will receive semi-annually at the 7% stated rate. Now we're going to determine the interest expense at the market rate for each of the first two interest payment dates. So you start out with your carrying amount, which in the beginning is $214,035. You multiply that by the 12% market rate, and then by 0.5 because it's half of a year. And we get the first interest amount of $12,842. So that's interest at 12%. Now we subtract from that amount the interest at 7%, or the amount of cash that we're actually paying our bondholders on the face amount of the bonds, $10,500. And the difference is the amortization of the discount. So over the life of the bonds, we will amortize that discount that the bonds were issued at, so that the actual carrying amount at the end of the 10 years would be $300,000, which is the amount that we owe the bondholders. Now, to get the next carrying amount, we take the old amount, the previous carrying amount, we add the amount of the discount that was amortized, and that increases the carrying amount to $216,377, and that is the amount you use to calculate the interest for the next semi-annual interest payment date. And we multiply that by the market rate of 12% and then times 0.5, and we get the interest amount of $12,983. We subtract the cash paid of $10,500, and we get the discount amortization of $2,483, which when we add to the previous carrying amount gives us a new carrying amount of $218,860. The third part of the problem asks us to journalize the issuance of the bonds on January 1st, 2024, and the first and second payments of the semi-annual interest amount and amortization of the bonds on June 30th and December 31st, 2024. So when we issue the bonds, we've already determined that we actually received cash of $214,035. The difference between the face amount, or the maturity amount of the bonds, $300,000, and the amount of cash we received is the amount of the discount, which was $85,965. And then we credit bonds payable for the face amount, or the maturity value of $300,000, because that is the amount we will actually pay the bondholders back at the end of 10 years. Now, the next entry will be for the first interest payment that we make on June 30th. We calculated our interest expense at the market rate to be $12,842. We calculated the discount amortization to be $2,342, and then we will pay our bondholders cash of $10,500. The December 31st interest payment, the interest expense will be $12,983. The discount amortization is going to be $2,483, and we will pay our bondholders cash of $10,500. And that is the conclusion of the demonstration for problem 12AB 38A.